Good morning, everyone. Welcome to our DAT Weekly Market Update. This is our update for January 17th, 2023. I'm Ken Animo, Chief of Analytics over here at DAT. I'm joined by Dean Croak, who's our Principal Industry Analyst. We have a very special guest this week. We have Larry Gross joining us. Good morning, gentlemen.
Good morning. Welcome, Larry. Good to have you with us.
Thank you to have me.
It's great to have you with us. The audience asked and we answered. We had a ton of questions about your area of expertise last week, Larry. So, Dean, we were very fortunate to have Dean with all of his industry connections to bring one of the preeminent experts in this area on the show this week. So thank you for joining us.
It's my pleasure to be with you. Thanks for having me.
Do you mind giving the audience a quick intro of yourself and what you've been up to in the industry?
Well, I'm now been in the industry about 43 years, go all the way back to 1980. For the last 20 years or so, I've been an independent analyst whose job is to basically follow the North American intermodal sector at about 40,000 foot level. I put out a monthly analytical report called Intermodal in Depth, which many of the major intermodal players subscribe to. It looks at what's happening in the intermodal sector, provides a forecast, and gives me sort of a window on what's happening in this business. So I'm happy to share some of that with your audience today.
That's awesome. So I expect quite a few questions. So if you want to go ahead and get those in early, our marketing team will sift through those and get them loaded up in our chat window over here for the end of the program. So we're going to send Larry away for a few minutes while we get to our market update, and then we'll bring him back once we wrap that up. So I'm going to get to our key points of the week to move us along here. So quite a bit going on. So spot rates are starting the year essentially within the same range as 2018 levels. We had a very strong end of the year. It seems like some of that strength is permeating into the start of the new year, which I think is good. Equipment post double 18 and even 20% more than 19 levels. There's a lot of reasons why we track load board activity here, mainly so our customers are informed, but also so our engineers are monitoring the health of our network, and we are seeing very ample activity volume on the load board, which again I think is promising as we head into the new year. California bracing for more landslides, road closures, and excess rainfall. Just keeping an eye on what's happening over there and keeping those folks in our thoughts. Michigan State truckload ton mile index is up 1.1% year over year, November, but flat sequentially. And last but not least, December used truck prices down 5% month over month, but still up 25% versus the pre-pandemic peak. So with that, I'm turning it over to Dean to walk us through the market update. Dean?
Yeah, thanks, Ken. As we start the year, it's a sort of an unusual start for carriers in particular as you think about capacity. This week's going to make 3 short work weeks out of the last 4. Talking to some carriers over the weekend, they're very hungry for miles. They're looking to get back into the miles to play catch up. Normally they base a lot of their revenue on at least 5-day working weeks anyway. So looking for a catch up there. Last week, though, capacity did return to the market. A lot of carriers came back to work. It was the first full week I saw carriers back operating at peak levels. There was a 60% week over week increase in carrier equipment posts to reflect that. Load post volume spiked up 21% ahead of the short work week. This week, following Martin Luther King Day yesterday, volumes are still within 1% of 2021 levels, though, and the third highest in 6 years for the second week of the shipping year. So pretty strong spot market for dry van in terms of volume. Load to truck ratio at 4.20 this week. In the refrigerated market, spot market volumes have been impacted, as they have been for the last year, by produce volumes. They're about 8% lower year over year. And particularly as a result of the Californian floods at the weakest level since 2016. The ongoing flooding, lots of road closures have slowed carriers down. In particular, growers haven't been able to get in to harvest crops. Volumes in California are down at their lowest level since 2010 and about 70% lower than where we'd normally see truckloads out of the Golden State each year. Equipment posts also at their highest level for reefer carriers, highest level in 7 years, actually. So the load to truck ratio almost dropped by a half last week to 4.80. And in flatbed, load posts are up 21% week over week, still 73% lower than this time last year, very low. And as you'd expect, the weakest in 7 years for flatbed load post volumes. Carrier equipment posts are also at the highest level in 7 years, plenty of capacity, even 41% higher than in 2019, which was an oversupplied market. Load to truck ratio at 12.69 this week. So having a quick look at some of our markets, standout market this week was Houston. It was the only top 10 market to post a gain in spot market volumes last week for dry van, up 6% week over week. It's held onto the number one spot for quite a while now. Available capacity wasn't impacted significantly, though, by the higher volume. Spot rates decreased by just under 2 cents a mile to an average of $1.84 for outbound. Having a quick look at our top 10 markets overall, they represented about a quarter of our national volume last week. Top 10 volumes were down 11%. Notable declines in Joliet and Chicago, which are big intermodal markets that no doubt Larry will cover later. Truckload volumes in those two markets dropped 16% and 29% week over week, respectively. Outbound line haul rates in both markets dropped by 8 cents a mile to $2.50. And in California, where residents are bracing for another round of storms this week, state level spot rates dropped by 2 cents a mile to $2.17. That's the lowest in the last 4 years. On the high volume lane, Stockton, Los Angeles to Stockton, rates at $2.84 were just under 10 cents a mile higher than in December, but a whopping 38% lower than this time last year when we had a record 109 container ships waiting to unload. And for those that have been following us, you'll know that Los Angeles to Stockton is a high volume lane for retail imports into that large warehouse market. Having looked at the refrigerated market, staying in California, the ongoing storms are impacting produce volumes as expected. Volumes are down significantly. Outbound state level reefer spot rates down 1 cent per mile to $2.42 per mile. That's the second lowest in 7 years out of California. Los Angeles to Las Vegas have been rising, though, in contrast over the last month, and at $4.69 a mile, 35 cents a mile higher than in December, but still about $1.50 a mile lower than this time last year. Seattle loads out of Los Angeles paying $2.64, up 30 cents a mile in the last month. Loads east of Phoenix, though, continue to cool off, dropping 10 cents a mile to $2.87. Southern border volumes are coming up as we expected due to the shortages from California. Lots of volume coming across from Mexico. Weekly truckload volumes across the southern border are up 7% year over year and the highest in the last 12 years. Most of that volume is coming through Laredo and McAllen markets, where volumes are up 18% year over year. And of course, this time of the year, we start to see a lot of avocados come in ahead of Super Bowl. Avocado loadings across the border are up 22% year over year as retailers position inventory ahead of peak demand in the next few weeks. Having a look at the flatbed market, capacity is still tight in Illinois last week. The state average outbound rate jumped by 27 cents a mile to just under $3 at $2.99. That's exactly where Illinois rates were in 2018. In the combined Bloomington and Joliet market, spot rates are up 8 cents a mile to $3.20. Regional loads to Eau Claire, Wisconsin, up to $3.78. That's 53 cents a mile higher than in December. And having a look at our top 10 markets for flatbed, which accounted for 30% of our national flatbed volume last week, all reported an increase in volume, with Houston remaining the number one flatbed market by a long way, as it has done for many months. Volumes are up 36% week over week. Still plenty of truckload capacity, though. Rates dropped for the third week in a row to $2.33 for all outbound loads. And wrapping up our market update with our year-over-year look at spot rates, national average dry van rate decreased 2 cents a mile last week to a national average of $1.93. That's 30% or about 81 cents a mile lower than this time last year. It's also about 24 cents a mile lower than the top lanes we have for volumes moved, the top 50 lanes. Last week's national average for refrigerated plunged last week, down 10 cents a mile to $2.27. Unlike week 2 last year, spot rates are about 30% or 94 cents a mile lower. Last week's spot rate was about 17 cents per mile lower than this time in 2018. And lastly, with flatbed, the national average rate of $2.14 last week began the year about 60 cents a mile lower compared to this time last year, but about 4 cents per mile higher than this time in 2018, which of course was an excellent year for flatbed carriers by all accounts. The national average rate decreased 2 cents a mile last week, but is still about 22 cents a mile higher than in pre-pandemic years for week 2 of the shipping year. And with that, it's over to Ken for the market update. Remember, before the short-term forecast, before we go, just remember you can download our market update at dat.com/market update. That'll be published this evening. You can get the long form version of this report. Over to Ken for the forecast.
Thank you kindly, Dean. So this forecast model is going to make my job pretty easy this week. So for those not familiar with this chart, this is our short-term forecast. It goes out 35 days. The blue line is a rolling 7-day weighted moving average of historical rates excluding fuel, line haul only. We start with dry van. And then it's really hard to tell the colors apart here, so I highly recommend you look at the legend down below. You've got Ratecast in green, that's our flagship model that's in all of our products. You've got red, which is the short-term model, which more heavily weights data that it's seeing more recently. And then you have the yellow and the gray, which are blends of the two in varying degrees and mixtures. So the models seem to be pretty much in agreement. We're going to continue to bleed off some of the strength that we saw in rates driven by the holidays as that return volume bleeds out of the system. But I do think one of the positive things you're seeing is that it shows the other side of that. So we're only roughly a month away from the forecasts, all four of them pretty much agreeing that we're going to start to see rates bounce back here sometime by mid-February. My guess, just based on experience, is that's a little bit optimistic, but it is showing a rebound in that $1.80 a mile range. But that's, again, for very long-haul freight over 600 miles, 550 miles. Let's go to refrigerated. Again, making my job easy. A little more disagreement. So the short-term forecast is expecting a bit more of a earlier pullout happening more towards the front of February, whereas Ratecast and the other models see some pronounced weakness heading into the middle of the month. I think right here it's really hard to tell. I think it's going to be weather dependent. It's really hard to predict some of that very early growing season. So we'll watch it closely and keep you all updated on what's going on. And then to end, we have flatbed, which is essentially a punt, if you will. All four models are basically going, it's going to remain relatively constant. There's not as much seasonal pressure right now in the flatbed market. Dean covered that off quite a bit in his market update. But I think what we would expect to see is pending a major coast-to-coast storm event or something like that, I would expect rates to hold pretty much where they are until we seek some direction for where that spring housing and remodeling bump, if it happens, when it happens, and to what extent it happens. So that's the short-term forecast. We'll try in the next few weeks to get a long-term view now that we're in 23 for everyone. But given our guest, we're going to move to our question of the week. Dean?
Yeah, good question for Larry to kick off the segment. Larry, how did Intermodal close out 2022, and what does it say about where we're headed in 2023?
Well, Dean, there are two main data sources that we can follow with regards to Intermodal. One is the AAR, or Association of American Railroads, weekly data, and that has the advantage of being really timely. We were able to see on each Wednesday what's happened with regard to intermodal activity the preceding week. So it's very timely, but it only gives us a very top-line view of things. But that's the one that right now we have coming right up to date. And so if we look at last year, we closed out the year in North American Intermodal with a deficit of 3.8% versus prior year. And if I look at that by geographic region, U.S. was the worst at about 4.9% deficit. Canada was in a very slight deficit position of about 0.9, and Mexico was a little bit in the black at 1.3. So, let's just say a disappointing year with regard to intermodal. We don't have the other source of data that we use extensively is the Intermodal Association of North America, or IANA data. They have a database called the ETSO database, equipment type, size, and ownership. And what that lets us do is it lets us segment the intermodal market into the two main areas, one of which is international, the movement of ISO containers off of the ports, 20s and 40s. That's one market. And then the other market is what I'll call the domestic market, which is the movement of 53-foot domestic containers, whether owned by large intermodal players like J.B. Hunt or Schneider or people like that, as well as folks like FedEx, UPS, and such. And we only have that data yet through November. But if we look at that through November, the international side was down 6.2%. And the domestic side just down a fraction at 0.9. So a lot of the weakness right now is on the international side, which is being driven by what's happening with our import-export situation.
Right.
With regard to where we're going, well, certainly I think on the domestic side, there is more of a growth opportunity than there is on the international side. We are at the very end of what has been a historic import surge that's lasted really for the entire post-pandemic period. And now we've come to the end of that, and that's going to drive that international piece, continue to weigh on that. On the domestic side, we are hopefully coming out of the congestion and capacity issues that we've had. So the industry, at least from an operational standpoint and capacity standpoint, is poised for growth. The problem is they've kind of missed the window in terms of the kind of market that you folks are tracking. And so I think for them to take share back is going to be a little bit of a challenge in what is going to be a much more challenging soft market conditions. So my expectations are muted, I guess I would say, with regard to 2023.
Right. Now, in terms of the railroads picking up market share, how much do you think the recent labour dispute will impact that? Because, I mean, during the pandemic, there was a lot of furloughs of engineers that, anecdotally, we've heard reports that it's been hard to bring them back online in anywhere near the volume they need. So in terms of improving capacity on the railroads, how much are they limited by ongoing staffing issues, do you think?
Well, certainly market share, intermodal market share has really tumbled here in the post-pandemic period. And it was a combination of the fact that the railroads did not have sufficient crew members to run their operations in a normal fashion. So service really suffered at the same time that the trucking industry was able to recruit drivers and add capacity.
Right.
So, just to put some numbers on it, if I look at the domestic piece of intermodal, normally I would say pre-pandemic that was running somewhere just south of 7% of all long-haul U.S. truckloads, defining long-haul as 500 miles or more. Roughly 7% of that was moving in domestic equipment, primarily domestic containers. Right. Most recently, in 2022 Q3, that was down below 6%. So that represents an opportunity, a pickup opportunity, even just to get back to normal. The railroads now, the service is getting back into the normal range. So I think that's no longer a constraint. The strike threat definitely, in the near term, in the short term, held people off of the rail. That strike threat is now eliminated. So I think those constraints are gone, but the industry is going to have, I think, quite a challenge to bring that market share back up even to normal, what I would call previous norms, rather than even accelerating it beyond that.
Right.
Hey, Larry, we have a lot of folks that listen are very interested in drayage, and I would admit that's an area that Dean and I aren't particularly well versed in. What's your outlook in 23, and maybe give some shades of comparison against 22 in the drayage market?
Well, there are no sort of, I'll call it equivalent drayage statistics like you folks provide on the truckload side, but we do track. I track, along with my friend Jason Hilsenbeck at drayage.com. We have what we call the drayage demand index, which is essentially a measurement of the number of clicks that his website is seeing looking for drayage capacity. And the dray market was one that was extremely heavily affected last year and the year before by congestion issues. The productivity of the typical driver and tractor over the course of the day, the number of moves that they could handle, declined significantly. So that was, in effect, pulled a tremendous amount of capacity out of the system and created, I'll say, an artificially high demand. The supply-demand equation got out of whack, not because of huge demand, although demand was high, but impaired productivity. We're now getting to the point, you see all of the ship queues off of the ports have disappeared. The ports are becoming more fluid. The last frontier of this congestion story is the inland warehouses and their ability to accept the loads and turn the equipment fast. But in a sense, because productivity is coming back into the system, capacity is flowing back into the system, even if there aren't any more drivers and tractors entering. So that whole situation, I think, has become quite a bit, I'll say normalized versus sort of the superheated situation that you had over the last two years. And so a lot of folks split off from these large drayage carriers and founded their own little companies. And now that trend has reversed. They're finding the market less hospitable, and they're going to go back into some of these larger companies where they can have a more secure load, load flow and more assurance of having work to do. So I would say the situation is going to be considerably easier in 2023 than it has been in the last 2 years.
I mean, it's just remarkable, right? I mean, every little subpart of our industry moves in the same relative cycle, right? They splinter off on their own. They're finding all, the abundance of loads and high paying, and then it dries up, and then they go back, and then the demand spikes for drayage or intermodal or truckload or LTL, and then they all come back out. So the cycle is real.
No doubt.
And remarkably consistent.
Larry,
what do you think? What else?
One question we had that came up a lot, and I've seen this a lot on our interstates. I saw it even last week, where I'm seeing 40-foot, international boxes moving 400-500 miles away from the port. We've even had carriers tell us they're running Savannah, Chicago. So my question is,
drayage.
Drayage. So my question is about long-haul drayage, and is that sustainable? But has this shift of imports from the west to the east coast driven a lot of that longer haul drayage off the east coast? And do you think that'll be sustained?
So there are sort of two factors. Number one, the shift from west to east is real, and it's been there for a long time, and it has certainly been in evidence here lately. There are two main factors that are driving that, one of which I think is a long-term shift, and the other is just a short-term problem. The long-term shift is that we're seeing a disengagement from China towards other sourcing locations, some of which are more naturally coming into the East Coast. If you get far enough west, let's say past Singapore, then the short route to the United States is via the Suez Canal and coming into the East Coast rather than going through the Pacific and coming into the West Coast. So that's a long-term secular change that's driving west to East Coast migration. In the near term, the biggest issue is that we still don't have a settlement on the West Coast with regard to the labor dispute between the longshore workers and the ports.
Right.
And that contract ran out at the end of July, and they're still talking. And there's I'll say a commitment, I'll put that term in quotes, on both parties to not disrupt the cargo flows, but based on previous experience, the importers are very skittish. And so that is driving a lot of, I'll call it, short-term shift away from the potential congestion issues that would occur if there was, I'll say, a breakdown in those talks. Those talks cover everything from the Pacific Northwest down to LA. So the entire U.S. West Coast is sort of in play right now. And so you're seeing a lot more volume going through the canal, Panama Canal in this case, coming around to the East Coast, just as a sort of a diversification strategy to keep the freight out of what is potentially a congestion situation.
Right.
Well, the longshoremen's negotiating leverage has largely evaporated over the last 9 to 12 months, right? I mean, wouldn't you say, or is that kind of a...
Repeat that question, please, Ken. I'm so sorry.
No, so the negotiation leverage that the longshoremen had when the market was, there was 220 some boats off the coast and it was super tight. It seems that some of that has evaporated as the market has cooled and normalized back a bit.
Yeah, but they have such a commanding position within that arena that I would not say that really significantly affects the discussions here. The big issue on the West Coast is automation. And the longshore workers are dead set against further automation of the terminals, the port terminals where the ships are unloaded. The carriers, would like to be able to make use of that technology, and that's really where one of the flashpoints is, and very hard problem to solve.
Larry, are you seeing a kind of a change in temperament at all between East and West Coast ports on automation, or is it pretty universally opposed by the by labor.
Yeah, well, I mean, we have another union that there are two separate unions covering the East and the West Coast. On the West Coast, it's the ILWU. On the East Coast, it's the ILA. They both have, I'll say, similar opinions with regard to port automation. So I think it's going to be a problem on the East Coast as well. Those contracts are on different timings, so that isn't really up in the air at the moment. The problem on the West Coast is that the longer this goes on, the more damage gets done with regard to this the west to east shift, and not all of that volume is going to come back. And the longer this goes on, the more damage is going to occur.
Right. Larry, one more question. When we talk to West Coast dray operators, in particular Long Beach, Los Angeles, one of the things they've said repeatedly is inability to get slots to either pick up or return empties. Do you have much insight into what's the delay there in terms of booking appointments?
So the problem is when we had this tremendous surge post-pandemic, you had a lot of volume that was flowing in the form of equipment that now resides within the U.S. Somewhere in the vicinity, on my number, 4 million TEUs. So let's say 2 million 40-foot container equivalents. Those all eventually need to be evacuated back to Asia. The only way that happens is if the ocean carriers are willing to actually bring ships in for the sole purpose of bringing the empties out. Because right now, what they do is they say, okay, here we are, we're coming into the Chinese New Year lockdown. They are what's called blanking voyages, which is essentially canceling the voyage because they don't have enough inbound volume. So their objective is to keep bringing the freight in on full ships, and then that means that they can't take out any more containers than they're bringing in. So there's 4 million containers, empty containers, really have no outlet. And the ocean carriers are very good at sort of externalizing the problem. So they're saying to the dray carriers, gee, sorry, we can't take these right now. Just hang on to them for a while. And there's no compensation for it. In fact, even sometimes the reverse, they get charged for hanging on to containers that they actually can't return.
That's exactly it.
It is a very problematic situation. And you're going to be hearing a lot more about that here in 2023. I saw a statistic that if you took all of the excess containers that are here in the United States and put them along the U.S.-Mexico border, we would form a wall 8 containers high across the entire U.S.-Mexico border.
Wow.
So that gives you an idea of the scope of the problem.
Yeah. Larry, in normal times, if we've got 2 million excess, what would normal times be?
Well,
how much?
I can't answer how many containers would normally be here. The 4 million is an excess number, so that's over and above what the normal number is. But frankly, I can't answer that question.
Okay.
Larry, I feel like we're going to have to spread your appearances. I'm sitting here live taking notes because I feel like I'm learning so much. I don't know.
Yeah, exactly.
There's only so much I can process on a Tuesday that feels like a Monday.
Well, I'm a candle in a dark room. Let's put it that way. All right.
Don't curse the darkness, light a candle is one of my favorite sayings. But it's just an area where I don't pretend to be an expert, and I'm just, we get so many questions, and when we're out visiting customers, they're asking, and I just don't feel like I have that part of the industry covered off. And I'm sure our viewers feel the same way. They're just learning a ton. And you just spouted off like you're reading your grocery list.
Pleasure to be here. Thanks, and you folks do an enormously productive job of covering the rest of the transportation world.
Yeah.
Thank you. So, Dean, anything to wrap up here, because we're probably running a little bit long.
Yeah. Yeah, just a couple of shout outs, Ken, if I could just go quickly. I'll be on
please.
Sales Chatter tomorrow with Dan Deegan, Ryan Muhammad, and Jeff Dickinson, 9 a.m. Eastern. Catch them on LinkedIn. Robert Rouse from DAT will be on Landline Now tomorrow evening. Also, check your calendar. Make sure you're available and can attend the 68th ACT Research Seminar in Columbus, Indianapolis, February the 21st. And just a reminder, you can also find out more about this week's market update at dat.com/market update or on our new IQ dashboard. And with that, it's back to Ken to wrap up the show.
Larry, where can folks get a hold of you to ask you questions or kind of consume your research?
Thanks. Well, my website is www.intermodalinDepth.com. And if you want to reach me via email, it's lgross@intermodalinDepth.com. And I'm also on LinkedIn under the name Intermodalist.
Love it.
There are a few places to find me, and I'd be happy to answer any questions that your viewers might have. I appreciate the chance to appear with such a distinguished pair here to chat with your audience. So thanks for the opportunity.
Yeah, we'd love to have you back next quarter if your schedule allows and you can get dug out of your snowpack there. Hopefully things are trending up next quarter.
Yep.
All right. So I'm going to sign off here for this week. I want to thank everyone for joining and the questions and the engagement. It's been great. We will be back next Tuesday at 10 a.m. Eastern. I think I'll be on an airplane. So, Dean, I'm sure we'll find someone to bring along with him to cover off on the show. But with that, I wish everyone a safe and happy week, short week. Hope you get that freight moving and hope to see you next Tuesday. Bye, everyone.
So long, everybody.
Bye.